ladies and gentlemen, welcome back to the channel. In today's episode, we have something special. We're going to be listening to a clip from Tom Lee. It's only about 3 minutes long, as well as 314 Research Warren Pies. Okay, these two fund managers are some of my personal, they hold some of the most respect in my view. 314's Research Warren Pies, he was spot on back in April. This guy did not miss a beat. Almost exactly as he projected, the markets evolved. Tom Lee is obviously someone that always provides some great insight, so we're going to get into that. But I also want to share my personal expectations and the foolproof way. Like, if you have two brain cells up top, to make a fortune no matter what happens next in markets. It's a lot simpler than you might think, but it does involve some emotional discipline. You can't be a crybaby out here and expect to make money. Okay, that's how it is. So I will share my personal game plan, what I plan on doing, how I plan on buying this market or hedging. I will let you guys know all of that in today's episode, so you're ready to navigate this market starting off on Monday. Do me a quick favor first, hit that like button as well as subscribe to the channel if you have not done so already, and check out that link down below in the description of today's episode to come join the trading community. Now, before we get into my thoughts on this market, my game plan ahead, and how I plan to navigate things to make a fortune, no matter what happens, no matter if we recover from here, no matter if we continue to crash from here, that's something you really need to hear, but I think you should hear the institutional side of things first. We're going to start this video with a clip from Tom Lee here that says, market pullback may be overdue to an extent.
Another big macro market voice. You know him, Tom Lee, co-founder, head of research at Fundstrat. Tom, it's only one day. We get it. We're still, the bull market we heard earlier, still intact. But your take on today's move and what may lie ahead.
Well, Brian, it may be overdue to an extent. We've had a nice rise of 36% since the April lows, and I believe today's decline is the biggest in more than 6 months. But it's good to see the VIX spike. The VIX spiked at 1.29% today. That's the 51st largest ever spike in the VIX. So we're a top 1% move in sort of what I'd say the market seeking safety. And so I think it's a good flush that's happening today. I would like to say the market is, concerned, but as your other guests have said, especially Rick, I mean, unless there is a real structural change, this pullback is a buying opportunity.
Wow, 51st biggest move for the VIX. So why is it good that the VIX is responding? What does that signal?
It shows you that investors are seeking protection. And as you know, the VIX is a measure of expected volatility of the largest 100 stocks. And so a spike in the VIX is really a market saying, okay, I need to get out of everything, but I can't sell everything. So let me hedge it by buying volatility. And that is usually a sign of an interim low. I mean, I don't want to say I think markets are bottoming today, but we know that the forward returns are pretty good 1 month and even 1 week later. So I would say if someone says, are we higher a week from today? I'm going to say the odds are actually really good. Or, we might even be 60 points higher.
Well, wow. But that's happened. That's what's been happening, as we talked about earlier in the show, Tom, that we've seen these buy the dip buyers come into the market. We get a day like today, the dip buyers come in, we're higher a week later. Do you expect that to happen again, absent some further escalation with China?
Yeah, I mean, anything's possible, Brian. And I think that the markets lived through this February to April, and it was a day by day panic, and maybe there's echoes of trauma people are thinking about, and we do know that this. These are important issues. So I wouldn't want to be glib in saying, hey, this is nothing. because the market is making a big move. But to me, if I said, okay, what are the reasons stocks have been attractive for the past 12 months? It's been about the innovation coming from AI, and it's the innovation as Wall Street looks onto the blockchain, and now it's the Fed that's beginning an easing cycle. These three things have structural tailwinds that aren't disrupted because of potential even rare earth dispute with China.
Do you want to see the market not end on its lows? We're not on our lows right now.
Well, it's Friday, and it's a long weekend. So as you know, a lot of people like to shut down their computers. So I wouldn't be surprised if we might see the market close on its lows. But to me, I don't think it's a signal. As you know, markets rarely bottom on Fridays anyway. So maybe Monday is the flush, but then that's the buying opportunity.
Interesting there. Tom Lee says that Fridays are rarely the bottom, and we could actually see a larger flush out event on Monday. But Tom Lee says until something structurally changes here, this is a buying opportunity. Basically what that means, until tariffs are actually in effect, this is a buying opportunity. And honestly, if we know Tom Lee, he's probably going to say after the tariffs go into effect, it is a buying opportunity as well. And I would also agree with that statement. But again, we'll get into my thoughts and what to do in just a few moments. But first, I want you to listen to what Warren Pies says about this market.
Research's co-founder, he joins us now. I'm looking at 3.3% down on the NASDAQ. Is that what catches your eye the most?
Yeah, thanks for having me. It does. I mean, that's where the leadership's been, so it's not surprising to see that's what's giving the most back. When I it's a little bit of a stressful day, I guess, but when I zoom out and look at the market and where we've come from, we've gone now 119 trading days in a row without a 3% pullback on the S&P 500. And that's the seventh longest streak without that kind of a pullback historically, going all the way back to the 1950s. And when you look at those streaks, we've returned like 28% before today. And that's the strongest performance we've seen within any of those streaks. So when I think about it, this is just, I think, a needed correction and a needed pullback, something we've been waiting for. Sentiment's been extreme. Talks of bubbles, talks of doubling between now and March of next year, and analogs to 1999. This is healthy. We're in this window where you'd expect it in October, and that's how we're approaching it as of now, as a healthy pullback.
But I mean, sometimes you look at these things and it sounds like this is what you're suggesting is we were overbought, we were due for a pullback, and now we're getting it. And sometimes you can't point to an actual catalyst that would send you into that sort of atmosphere in the market, whereas the difference today is we have a serious catalyst, and it's a renewal of tensions between the United States and China. We're talking about the possibility of more tariffs, not less. The market had sort of been anesthetized to the whole issue because we haven't really talked about it all that much, and it figured this too shall pass, and we'll get on to talking about rate cuts and positive earnings. But now we have a serious concern to think about, depending on what the president does and if he does it.
Yeah, I mean, it's a concern. I've been a little bit in recent weeks talking to clients and saying, we were so concerned about tariffs, and tariffs are a real drag. And we didn't have a full taco from the first round of tariffs, really. And so we've expected somewhat of a fiscal drag. Our recommendation for clients is to keep a full equity position and then have an overweight bond position, and in fact have skewed towards a little bit of duration. And you can see it on a day like this, because I think that if we're gonna have another flare up in these tariff negotiations or some kind of trade war, I think that bonds will end up being the place that you want to be, because it's going to manifest itself as a growth scare. So that's been the way we're playing it. I think we've gone through this, and ultimately we've already tested the limits of what Trump can tolerate. And I don't think I think the taco trade is still with us. Yes, there could be a little bit of danger in saying that. But if we get a little bit more weakness in this October period, I think you'll see a capitulation on his part, and ultimately we'll get back to where we were, a few weeks ago, and it's just going to be a nice sentiment reset. That's how I'm interpreting it.
So most of Wall Street is saying pretty much the same thing, that this is a buying opportunity, the trend is upwards, this is a sentiment reset, and I agree with all of that. But if I have to be the bearer of bad news, I will be. There is a small but possible possibility that Trump does not give a F about anything, and this does evolve into a much larger crisis, like recession, okay? There's a chance of that. I'm not hearing a lot of Wall Street talk about that, so I want to throw that out there. In the worst case scenario, you need to be prepared for that, okay? After a 3% decline from the highs, it's not the time to be all in on margin, okay? It's not, because there is the risk of a recession, which would be a substantial decline from here. The moment you want to go, quote unquote, all in on margin, which I'm not a financial advisor, I am not a financial planner, this is not a recommendation. If you listen to these videos, you will lose money, blah, blah, blah. Don't be a jackass, okay? But the time, theoretically, you would want to go all in on margin is when you're down like 20+%, right? That is when, historically doing that, you're going to do very well. It's not after a 3% decline. But after a 3% decline, you want to be real with yourself. What the worst case, best case scenario is. Best case scenario, Trump announces tomorrow on Sunday that, hey, he's going to have a call with China's president. They're going to try to get these things worked out. Stocks recover. In that scenario, you want to have taken advantage of the 3% decline because you're probably going to get most of that back the next day, right? There's always going to be the chance that at any moment, whether you can respond or react to it or not, that things are going to get much better. I think by far the highest likelihood is Trump doesn't want a recession. He doesn't want a bear market. He doesn't want, the U.S. to start falling behind in AI, blah, blah, blah. None of this is good for Trump's policies, okay? This is not in Trump's best interest. He even said yesterday that it could be painful for the U.S. He doesn't want that, okay? Great. Fine. We get that. That's the highest probability. But there is a possibility, albeit a low one, that this Trump trade embargo with China lasts 3 to 6 months, a recession comes out of it, and there's substantial downside from here. So how do you invest to make a killing during whatever happens next? It's simple. More simple than you'd think. Keep your emotions in check, number one. Whether it's a good day or a bad day, you don't want to get super excited on good days or super down on yourself on bad days, okay? Understand, if the markets fall, you're going to lose money. But that is not the end of the story here. That is how you make a fortune, okay? The more the markets fall, the more money you're going to make on the back end of it, okay? This is how we made hundreds of thousands of dollars, millions of dollars collectively in the trading community back in April. Check that link out down below in the description of today's episode. You want to, in my view, or at least what I'm doing, I should say, what I'm doing is scaling into markets. We were down on Friday. I put, just for context, I have hundreds of thousands of dollars in markets. I invested like $5,000 on Friday, something like that. Okay, just ballparking here on the 3%-ish down day we had. If Monday is a bad day, I'm going to put another 5 to 10 grand in. Okay? If the day after that's a bad day, I'm going to put even more money in. The lower markets go, the better your odds are that you're going to make money on the back end of that. But again, if things get worse, you want to be in a situation where you have plenty of cash to invest and take advantage of that. But also if things get better overnight, that you have already taken advantage of what we have seen. Here's the thing. I can say this, that I'm scaling into positions, that I'm putting all of this money to work, because my backdrop of my expectations, my game plan, the core thesis on why I'm bullish for the next 12, 24, 36 months has not changed. What is that backdrop? That is, I'm expecting the big beautiful bill, no tax on tips, no tax on overtime, being able to write off auto loan interest, 100% capital depreciation, among other things, is going to benefit the economy and the consumer by mid-2026. You're going to start to see and feel those benefits. That's number one. I believe inflation is going to come down. I think the labor market is not going to dramatically weaken, that things are actually going to start getting better in 2026. Okay? You're going to have plenty of Fed rate cuts. We're getting a new Fed chair, which is probably going to give us more rate cuts than we are expecting for next year. Okay? I believe AI is alive and well. I believe we are in an AI Cold War. I believe that we have no choice but to invest massive amounts of money into AI, and that is not going to stop. Okay? There's no other way around that. It's not going to stop. We are in a micro Cold War, which means like Microsoft is competing with Google, and Google is competing with OpenAI, blah, blah, blah. Google, for an example, has no choice but to spend as much as they possibly can on AI, because if they don't, what's left of Google 10 years from now? Okay, so that's a micro kind of AI Cold War, company by company competing with each other or working with each other. But then on the macro level, you have America versus China. Long before America loses the Cold War with China for AI, an AI arms race, if you will, the government's going to be giving out hundreds of billions of dollars in grants. Like, if you think we have an AI bubble today, I don't know where you get that from. Because last I checked, the government's not giving out hundreds of billions of dollars in free money for private companies to compete in AI. Okay? That's what will happen if we start to fall behind China. Okay? And again, just to circle back, none of this is in Trump's best interest to have a bear market in the US, right? That doesn't fit into Trump's game plan. That's why I think the odds are so high that we do get this situation worked out. But long story short, that is my solid foundational backdrop here, right? That is why I want to scale into markets. Now, if you think a recession's coming next year, or you think, XYZ inflation is going to be a problem, this is probably not going to make sense to you. Okay? And you ultimately want to come to your own conclusions. I think most of us agree with a lot of what I'm saying, right? Real estate starts to move next year. People are able to buy and sell homes. They're going to take hundreds of thousands of dollars to their bank account once they sell their home and are able to buy a new home at a reasonable price. As rates come down, they're going to have a lot of money to spend, right? Add that to the thesis. There's a lot of things going right for markets until we have a trade embargo with China that lasts 3 to 6 months and we actually get a recession catalyst. None of that changes. As I've talked about on this channel before, I think we are one big shock event away from a recession. November 1st is not a shock event. The duration can be a shock event, okay? If we have tariffs put on China, 100% trade embargo with China for a week, that's probably not a recession catalyst. If we have a trade embargo with China for 7 months, that's probably a recession catalyst. Once you get past like 3 months, things start to get really dicey, right? Things start to look rough. Do I think we're going to have a trade embargo with China for 3 months? Probably not. I think by far the highest likelihood is things will get resolved long before 3 months, or probably even before November 1st, okay? Again, there's a chance that does not happen. So again, how do you benefit from this? It is by scaling into markets systematically, day by day on these red days, but to not be in margin and to keep your emotions in check. If you're losing digits on your portfolio, it's simply digits. You got to be more in love with the game here than you are the benefit, and that is money. If you understand what you are doing over the long term, investing on these down days where your portfolio looks ugly, that you're going to come out a winner on top of that. That's all you need to know. Like back in April, before the April crash, portfolio was up like 40%, 50% year to date in the trading community, right? That was a couple months into the year. We were having a great year. What happened? Markets tanked. That portfolio was down like 25% year to date, something like that. Lost all of the profits plus some. What happened? We invested aggressively in April. As the markets went lower and lower, the risk reward got better and better and better, and I put more money and more money and more money into markets. Now, we sit, even after today, trading community portfolio is up like 190% year to date. It was up 220% year to date. Okay? I have not sold anything. I've barely hedged my portfolio. Some of you guys might hear that and say, wow, that's stupid. But again, with my backdrop, that has not changed. The economy is going to be strong. Inflation is going to come down, blah, 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 what I just went over. That makes sense to me. If I was fearful of a recession, and now we have this, and I thought Trump was serious, and tension or trade is done with China for an extended period of time, I would not be operating this way. But I would also likely not have 200+% year-to-date gains. I would have panicked out long before. I would have been trying to time the markets. I would have been fearful, back here, right? On August 1st, when the markets were down 1.64% and we had hit a new all-time high, I would have said, oh yeah, crap, that's it. Correction's coming. Like, again, you got to keep your emotions in check here and always circle back to your baseline expectation, which mine is bullish. Okay? So until something changes that, you got to scale into markets. You got to take these red days as opportunities. That is my plan. That is what I am doing. Let me know what you are doing down below in the comment section. But that is how you get rich during a pullback, during fear events, during crashes or corrections. It is by staying steady, keeping the long term in the back of your mind, and operating under that narrative. What do I have to do today to make this long term plan that I have a higher chance of success? Nothing is guaranteed in markets, but you can do things that raise your odds of your desired outcome. If your desired outcome is to make a lot of money, unfortunately, for some people, you have to be bullish because that pays. Okay? And if your long-term goal is to make a crap ton of money, you have to be buying on these red days, especially in a Trump economy, Trump market, if you will. You have no idea versus the next guy when things are about to get bad or really good. It's on a headline by headline basis. So the last thing you want is to watch the markets fall 3% on Friday, maybe 3% on Monday, whatever the number is, and then recover on Tuesday and you did not take advantage of it at all. Okay? You want to be mindful of valuations and bubble-ish areas. Like, you don't want to just go out and buy the most overvalued shit out there, but there are opportunities in any market. So again, let me know your thoughts and what you are doing in your portfolio down below in the comment section. Come join the trading community if you would like to. Link down below in the description of today's episode. Have a great rest of your day, and I will see you in the next one.